For the first time in 9 long months, the Federal Reserve of the United States made a move that was both anticipated and feared. The interest rate was lowered. The new range now stands at 4.25% compared to the previous 4.5%. On paper, it's just 0.25%. Such a tiny change may seem laughable to someone far from finance. What could possibly shift because of a few tenths of a point? But in the world of money, things work differently. Here, even the smallest move is like a tremor in the Earth's crust. It can trigger real shocks that ripple across all corners of the economy. Why is that? Because the interest rate isn't just a number in the central bank's report, it's the price of money. And when the price of money changes, everything else changes too. From how much a suburban family pays for their mortgage to how the largest corporations plan their investments for years to come. This invisible figure sets the rhythm of the entire economic life. Think about it. For 9 long months, the economy lived under a rigid freeze. The Fed didn't move, holding rates high, and in doing so, kept the entire financial world in tension. And now, for the first time, they've loosened their grip just by 0.25%. But the signal is clear. A new phase has begun. Most people, of course, will treat this news without much enthusiasm. For them, it's just a line on CNBC or a ticker in the evening news. But for those who look beyond headlines, it's a real message. The wealthy and the financially savvy see such moves as a green light, a moment to either build fortunes or, if unprepared, lose ground. It's important to understand such decisions are never spontaneous. No one at the Fed wakes up in the morning thinking, let's cut rates today for fun. Every change comes from a carefully built logic, the analysis of countless indicators and hundreds of hours of discussion. This time is no exception. For 9 months, they kept the rate unchanged and then decided to ease it slightly. The new range, of course, can't be called a historic low. The US has seen much lower rates in its history, but against the backdrop of the aggressive hikes of recent years, this is still a noticeable shift. If before the movement was toward tightening and making credit more expensive, now the trajectory has changed. To better picture the effect, let's use a metaphor. Interest rates are like gravity in the economy. When rates are high, a heavy force weighs on the shoulders of businesses and households. Taking a loan or a mortgage feels like climbing a steep hill with a heavy load strapped to your back. Every borrowing decision is harder, and every mistake costs more. That's exactly what things looked like in recent months. Mortgage payments became unbearable for millions of families. Credit card debt drained household budgets dry. Business projects were shelved because the cost of capital exceeded expected profits. The economy was moving forward as if with weights tied to its legs. And now, a single rate cut of just 0.25% changes the incline of that hill. Of course, the hill hasn't disappeared, but it has become slightly less steep. For those climbing, this difference is felt instantly. And in finance, even the tiniest adjustment can change the outcome of the race. Markets picked up on it almost immediately. Stock indexes perked up, bonds shifted in value, even Bitcoin reacted noticeably. Investors know if the Fed begins moving toward easing, money in the system starts behaving differently. Capital rearranges itself, seeks new directions, and the first waves of this process can already be observed in real time. But this is only the prologue. More important is the question, why did the Fed take this step now? What does it say about the current state of the economy? And most importantly, what opportunities or risks does it open up in the months ahead? To understand that, we must remember the main point. The Fed never acts for the sake of acting. They respond to signals that become too obvious to ignore. In recent months, inflation has gradually cooled. It hasn't disappeared, but it no longer accelerates as before. If in 2022 price growth was suffocating families, now the situation is calmer. Groceries are no longer soaring at the same pace, gasoline no longer punches holes in wallets every week, and yet inflation remains above the 2% target. That's why the Fed kept rates high for 9 months. They wanted to be sure the fire was really dying out. But at the same time, a new threat emerged. Overly tight policy began hurting the economy itself. The labor market showed its first cracks. Unemployment ticked up, companies slowed hiring, and some even started cutting staff. Here lies the core dilemma. Keep rates too high and the economy stalls. Cut them too fast and inflation flares back up. That's why the current step looks like a compromise. It's not throwing the doors wide open, it's more like slightly opening a window. A light breeze to relieve the tension and test how the air changes. The key takeaway everyone must grasp. This is the first pivot. After 9 months of silence, the Fed has finally made a move. And markets understand this is just the beginning. When money gets cheaper, it immediately affects all asset classes, from stocks to real estate, from gold to cryptocurrencies. Everything starts moving in new ways. For investors, a rate cut isn't just economic statistics. It's a direct signal capital is looking for new places to grow. The stock market reacts first, and it's logical. When the cost of money falls, the future of companies is valued higher. Why does this happen? Because a stock's price is essentially the discounted value of a company's future earnings. If rates are high, those future earnings lose value. Investors think it's too expensive to wait 5-10 years for profits when they can put money into a deposit at 5% right now. But once rates drop, the equation changes. Future earnings become valuable again because the alternatives, deposits, bonds, yield less. This immediately pushes stock prices upward. The biggest winners are usually sectors like technology, real estate, and consumer goods, those most sensitive to the cost of capital. The second obvious channel of influence is the housing market. Mortgages are directly tied to Fed rates. When borrowing costs fall, more people can afford to buy a home. Demand rises, and with it, prices. This is a double-edged sword. On the one hand, more families finally get a chance at home ownership. On the other hand, rising demand pushes prices higher, making the market overheated again. So, a rate cut always stimulates construction companies, real estate agencies, and the entire sector, but it also creates the risk of a bubble. Cryptocurrencies and other alternative instruments also respond. For many investors, Bitcoin is the opposite of the dollar. When the dollar weakens due to lower rates, crypto is seen as a way to preserve and grow capital. Here, psychology plays a role too. As soon as investors feel the Fed is easing, they're ready to take on more risk, and crypto is the symbol of risk and of potential outsized returns. That's why even a small cut can spark a surge of interest in it. Gold and other precious metals react differently. They serve as a safe haven in unstable times. When markets wobble, gold acts as insurance. Big funds and institutional investors act especially fast. For them, a Fed cut is a direct signal to reshuffle portfolios. Bonds lose appeal, while stocks and real estate become more attractive. These players rarely wait for months. They start moving right after the Fed's announcement. That's why we see immediate jumps in stock market prices. Here we see the same contrast again. For the average person, a rate cut is relief on a credit card or mortgage. For the wealthy, it's the opportunity to launch entire strategies. They refinance their portfolios, taking cheap loans to pay off expensive ones. They buy assets while capital costs are low, locking in favorable conditions for years ahead. They expand businesses because they know cheap money is a chance to grow faster. This is why, after every easing cycle, the gap between rich and poor tends to widen. Some use the moment to secure long-term gains, others settle for short-term relief. But there are risks too. Many investors, inspired by rising stocks or crypto, start chasing the crowd. They buy assets at inflated prices, hoping for more growth. And when the Fed slows down or markets overheat, they lose money. That's why it's important not just to react, but to build a strategy. A rate cut is an opportunity, not a guarantee. For someone who wants to use this moment correctly, a few principles matter. Diversification. Don't bet everything on one asset, even if it's rising fast. Focus on sectors that benefit from cheap money. Tech, real estate, consumer goods. Risk assessment. Remember that every growth cycle can end in a correction. Long-term perspective. The wealthy win because they think in decades, not in days. At first glance, a Fed rate cut may seem minor, but for markets and investors, it's the start of a major shift. Stocks, housing, crypto, everything reacts. And those who understand the mechanics can use this moment to build wealth. A Fed rate cut is not just another headline. It's a turning point that changes the rules of the game for everyone, from a family with a mortgage to a billion-dollar fund. The only question is how you personally will respond to this signal. The most obvious area is debt. If you have credit card balances, car loans, or personal loans, this is your chance. Even if the cut seems small, it opens a window of opportunity. Now is the perfect time to think about refinancing. Banks will start offering better terms. Every percentage point you save is essentially a pay raise without working extra hours. Mortgages matter too. For those with adjustable rates, a cut can mean hundreds of dollars in yearly savings. For those planning to buy a home, it makes borrowing slightly more affordable, bringing the dream of home ownership closer. But there's another side. High-yield deposits and bonds that recently gave 5% will start to fall. If you were happy with those safe returns, they won't last. Simply leaving money money in the bank won't be as effective. You'll need to look for alternatives, diversify, invest, and not rely solely on fixed income. Historically, rate cuts push stocks, housing, and even crypto higher, but the key is not to act impulsively. Not all stocks will benefit equally. Those most sensitive to capital costs, tech, real estate, consumer goods tend to rise the most, but that doesn't mean buying everything blindly. A smart investor looks beyond short-term hype. They ask which companies will truly grow in the long run, which assets can deliver income for decades. That's how the wealthy think. Another important lesson: the wealthy never spend all at once. They always keep dry powder liquidity reserves to seize opportunities when they appear. For an ordinary person, this could be a few $1,000s in an emergency fund. For a big fund, tens of millions. But the principle is the same. Keep part of your capital ready to act when the market offers a chance. Every rate cut creates two groups. In the first, those who cheer that their credit card bill went down by a few dollars and stop there. In the second, those who see a strategic moment and restructure their finances, refinancing loans, buying assets, expanding businesses, building long-term plans. Years later, it's the second group that ends up wealthy because they use the moment not as a pause but as a launch point. The interest rate isn't just a technical indicator. It's one of the most powerful signals in the financial system. It tells you when to defend your assets, when to expand, and when to strike quickly. Every rate cycle redistributes wealth. Money doesn't vanish or appear out of thin air. It flows from the unprepared to the prepared. Think of rates as gravity. When they're high, everything feels heavier. Loans weigh down, businesses stall, consumers shrink back. When rates fall, that gravity eases and movement accelerates. The economy picks up speed. Now, after 9 months of silence, the Fed has loosened that gravity for the first time. The question is, will you see it as just another headline or as a green light to move faster, smarter, and bolder? In the end, it comes down to choice. For most, this will remain background noise, pleasant, but nothing more. For a few, it will be a turning point, a chance to lay the foundation of future wealth. Every dollar you save or invest wisely in such moments is like a worker that never takes a break. And in moments like these, you decide, will those workers crawl or sprint? Thanks for watching this video until the end. If it helped you see things from a new perspective, hit like, subscribe to the channel, and share it with friends. Drop a comment below. Do you see this rate cut as just a short pause or as a chance for new opportunities?